welcome to Mastermind Roundtable. Today it's me and Duncan again. Today we are going to talk about ESG investments.
Sure, Morris. Looking forward to it.
Yes, normally people would think that before ESG investments, you will earn pretty handsome returns from your equities, from your global portfolios. But now you have to reshuffle your portfolio holdings, basically match or to echo with your ESG advocates, policies. So what do you think about how, sustainable investing balance the financial returns?
I think it's balancing the risk and rewards because, as you say, as an investor, and insurance companies typically are long-term investors, you want to be able to own those sustainable returns, whether you hold the debt or the equity. It's about taking a balanced risk-based approach so that we assess those risks for those companies, and we want those companies to have resilient business models so that they can generate those returns. So ultimately for us, we want them to be able to repay their debt or pay the interest on their debt, or we want their business to keep growing in a sustainable way, and we don't take necessary judgment calls in terms of excluding particular sectors.
Really?
Because we're not a moral-based investor, so we wouldn't, for example, exclude alcohol-based or gambling-based securities or bonds. What we do is all risk-based. If we've excluded certain assets or certain sectors, for example, coal, it's because we've taken a view that they present stranded assets in the long run. And if we're still holding those assets on our balance sheet, then we could be facing impairment or losses. And as a long-term investor, we do not want to be in that position.
Which makes sense. Many people believe there might be certain regulations or internal policies to prohibit related bonds or securities, carbon-consuming intensive industries. So it seems it is still based on the risk-based approach to manage the portfolios, right? In general, would it be like after I adopt the ESG investment policies or approach, my financial return actually become worse?
I think the jury is still out, to be fair. There is a mixture of sources out in the market and studies. Some show strong returns and others show varying returns on such kind of portfolio. So it really does depend. But it also, I think, in terms of ensuring what you want to do as a company from your commitments and your ambitions is also, the financial returns obviously is important because for us as a long-term investor, we need to be able to generate those returns from our assets to meet our long-term liabilities. But when you marry that with the corporate commitments such as net zero and decarbonization, you need to then also pivot your portfolios in a way that meets those. And so that's where the data and the taxonomies and the analysis comes in.
Yeah, which makes sense, especially that your company is a listed company. When balancing the financial returns in the meantime, you would also need to consider, because after all, ESG consists of three components. Not just financial returns, but also care about whether you are environmentally friendly, whether you are socially responsible, and whether you have very strong internal governance, right, as well.
Yes, and I think irrespective of the corporate attitudes, the regulators will increasingly ask certainly listed companies to disclose more. The Hong Kong Stock Exchange is a good example of that. And they have certain listing requirements that all the listed companies would need to comply with. So that has a bearing as well. But of course, for us, net zero, the corporate commitment towards decarbonization is something that we've voluntarily done because we believe it is good. It's the right thing for us and our purpose, but it's also the right thing for the communities that we operate and support. And we operate in 18 markets around Asia.
I think you mentioned one very important keyword, purpose. That's the keyword driving so many corporations, I think, in their policies and decision makings.